The market is shifting, and Morgan Stanley's Mike Wilson wants you to pay attention. In a rare turn of bullish tone, Wilson highlighted a series of underappreciated tailwinds that could continue driving equities higher, even in the face of macro uncertainty. One of his key calls? The weaker US dollar, a force he says is acting as a major earnings tailwind for multinationals. According to Wilson, the currency drop is as powerful as what we saw coming out of COVID, giving global companies a surprise lift in revisions and revenue momentum. But that's not the only bullish signal. Tariff concerns, which rattled markets just months ago, are now fading into the background. As Wilson puts it, the situation has evolved from a crisis to something less bad, and that shift, combined with overly pessimistic earnings revisions, is creating a reflexive upside. Add in falling oil prices, which help offset costs for consumers, and the result is a market that's starting to price in resilience, not fragility. And what about the megacaps? Wilson says forget the law of large numbers. Companies like Nvidia and Apple still have scale, operating power, and in many cases, monopolistic advantages that allow them to defy gravity. The risk isn't their size, it's whether they can maintain their dominance, he explains. In short, Wilson sees a landscape where the right companies in the right pockets of the market can outperform. That brings us to Morgan Stanley's own portfolio moves. In the first quarter of 2025, the firm trimmed its stakes in Nvidia, Microsoft, and Amazon, but it wasn't retreating from tech, it was reallocating. In this video, we'll break down the 3 tech stocks Morgan Stanley bought instead, a bold bet on the next leg of this AI-driven rally. First on the list is Broadcom Inc., ticker symbol AVGO, a tech giant that Morgan Stanley boosted its position in during Q1 2025, signaling strong conviction in the company's long-term AI potential. And it's not hard to see why. Broadcom has quickly emerged as one of the most strategic players in the AI infrastructure ecosystem, delivering custom AI accelerators and networking solutions that are in high demand across the world's largest data centers. Broadcom's AI momentum is nothing short of explosive. In the second quarter of fiscal year 2025, AI-related revenue surged 46% year-over-year to $4.4 billion, driven by robust growth in both its custom chips and AI networking segments. This isn't just a short-term trend. Management expects AI revenue to grow another 60% next quarter and continue accelerating into fiscal year 26. Hyperscalers are shifting away from general-purpose GPUs to tailor-made AI chips, and Broadcom is capitalizing on that shift. Its cutting-edge Tomahawk 6 switches, capable of 102.4 terabits per second, are enabling massive, more efficient AI clusters, solidifying Broadcom's role in next-gen training and inference infrastructure. But Broadcom isn't only about silicon. The successful integration of VMware has unlocked a powerful software revenue stream, adding stability and diversification to its business model. Infrastructure software revenue jumped 25% year-over-year last quarter, as more enterprise clients transition to VMware's full cloud stack. Operationally, Broadcom is firing on all cylinders. Adjusted EBITDA rose 35% year-over-year to $10 billion, with margins climbing to 67%. The company generated over $6.4 billion in free cash flow and returned a combined $7 billion to shareholders through dividends and buybacks, while still chipping away at acquisition-related debt. In short, Broadcom is executing a two-pronged strategy: dominate the hardware stack for AI workloads and lock in long-term enterprise software customers through VMware. With a $60 to $90 billion AI opportunity on the horizon by fiscal year 2027 and clear leadership under Hock Tan, Broadcom is proving it's not just participating in the AI revolution, it's helping build it. Next is Meta Platforms Inc., ticker symbol META, a stock that Morgan Stanley increased its stake in by nearly 5% during Q1 2025, showing clear conviction in what might be the most ambitious AI pivot in Silicon Valley today. At the center of it all is CEO Mark Zuckerberg, who's fully activated what investors call his founder mode. And this time, it's not about the metaverse. It's about building a world-class AI super team capable of putting Meta at the heart of the next technology wave. Zuckerberg isn't just hiring aggressively, he's constructing a fortress. The newly formed Meta Superintelligence Labs (MSL) includes talent from OpenAI, Google, and Anthropic, along with a $14.3 billion stake in Scale AI and heavy investments in engineers like Nat Friedman and Daniel Gross. This isn't a side side project. It's a moonshot that could reshape Meta's future across advertising, messaging, and digital infrastructure. But AI isn't just about future potential. It's already transforming Meta's core business. From automating ad creation to enhancing targeting algorithms, AI is making the company's platforms more efficient and more valuable. Meta plans to fully automate the ad journey by 2026, removing friction for advertisers and unlocking more time and attention from users. That's a powerful 1-2 punch for monetization. Then there's WhatsApp Business, one of the most overlooked AI monetization frontiers. With hundreds of millions of users and a fast-growing non-ad revenue stream, AI-powered message-based commerce could become a major revenue engine for Meta. And let's not forget Meta's AI hardware ambitions, from Ray-Ban smart glasses to Project Orion, positioning the company for any shift in user behavior beyond the smartphone. Despite heavy capex and near-term margin pressure, Meta delivered 16% year-over-year revenue growth in Q1 2025 and record operating margins. Zuckerberg is betting big, and so is Morgan Stanley. In a world where AI will separate the disruptors from the disrupted, Meta is clearly playing offense and playing to win. And finally, we come to Alphabet Inc., ticker symbol GOOGL, the tech titan that Morgan Stanley quietly added to in Q1 2025, boosting its position in both GOOGL and GOOG. With the market hyper-focused on AI competition, especially the threat from OpenAI's new AI browser, many investors are underestimating just how resilient and diversified Alphabet truly is. But Morgan Stanley clearly isn't one of them. The headlines might scream panic: OpenAI is launching a browser, taking aim at Chrome's dominance. And yes, Google search still accounts for nearly 3/4 of Alphabet's revenue. But here's the nuance. Chrome isn't a sitting duck. It holds a 68% browser market share, remains the default on Samsung devices, and now integrates Gemini, Google's conversational AI that's being built directly into the browsing experience. In fact, OpenAI's own browser is built on Google's Chromium engine, a subtle reminder of Alphabet's deep infrastructure advantage. More importantly, Alphabet's growth story is no longer just about search. Two major catalysts are driving future upside: YouTube and Waymo. YouTube has cemented itself as the king of digital video with over 2.5 billion monthly users, a fast-growing shorts business, and an expanding share in total TV usage. It's also becoming a major driver of ad revenue, helping offset any pressure from browser-related shifts. Then there's Waymo, Alphabet's autonomous vehicle unit, which is quietly locking in 250,000 paid rides per week and expanding in key markets with strong regulatory support. As Tesla talks, Waymo executes, with Uber partnerships, teen pricing strategies, and a head start in government approvals. Even as antitrust noise and AI competition weigh on sentiment, Alphabet trades at a discount compared to other tech giants. And with Google proving it can innovate, adapt, and diversify faster than many expect, Morgan Stanley's bet signals confidence in the long game. Chrome might face challengers, but Alphabet's ecosystem, from AI to ads to autonomous, remains one of the strongest moats in tech.